One of the analogies that I often make is that in many ways the 2010s were a lot like the 1930s, and the 2020s are shaping up to be a lot like the 1940s. Policymakers essentially box themselves into a corner where interest rates are super low, debt's super high. Other than inflating part of that debt away, they don't really have a ton of options for how to get out of that.
Please join us for our next live stream Sunday, June 20th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, June 20th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. As always, if you are new to our channel or if you haven't already done so, please do subscribe, hit the bell to be notified of new updates, and give us a thumbs up if you like what we do. We truly do appreciate your support. Lyn Alden is our guest today. She is the founder of Lyn Alden Investment Strategy, which provides equity research and investment strategies that allow the managing of money through all market conditions. Lyn has over 15 years of experience in various public and private capacities, and her work has been featured or cited on well-known publications such as MarketWatch, CNBC, Real Vision, Times, Money Magazine, and many others. And we are delighted to have Lyn here today as a first-time guest. It's time to saddle up and silver up for Lyn Alden. Lyn, welcome to SBTV. How are you doing?
I'm good. Thanks for having me.
Thanks for coming on. Appreciate it. As I was saying, we see you all over on a whole lot of other people's channels, and the information that you give out. Top notch. So we're really glad we could get you on. Appreciate that.
I appreciate that, and I've seen a number of your interviews, and I'm certainly happy to give updates wherever I can.
All right, thanks again. Appreciate that. Lyn, as a first-time guest on our show, can you share with us your journey from electrical engineering to finance, and what led to your decision to make that switch?
Sure. Yeah, for me, most of the story was that they were in parallel. And so, for example, I've been investing ever since I was a kid and a teenager. But when it came time to go to university, I went into engineering instead of finance because I'm also interested in technology. It was also just kind of an economic decision to go that route. But I never really lost that passion for the financial side of things. And so after I worked as an engineer for a while, I got a master's in engineering management that focuses on financial modeling and kind of project management, and kind of shifted more towards running the finances of an engineering facility and kind of blending some of those passions. But then on the side, I also just kept following financial markets. I kept investing, building my knowledge base in there. And then in 2016, I decided to launch Lyn Alden Investment Strategy. And the way I view it is that engineering and finance are actually pretty, there's a lot of overlap there because a lot of it's math-based, being quantitative, is looking at things on a systems basis. And so overall, it was not a super hard shift, especially because it's something that I've been, kind of doing in parallel, from the get-go.
Okay, pretty cool. Something similar. Many moons ago, I used to do electrical work myself. I wasn't the engineer. I was the guy in the hard hat doing the work that you drew up on the blueprints for us to do. But you noted in your newsletter that similarly to the 1930s, the government response after the 2008 crisis and into the early part of 2010s had a relatively large fiscal component. Decade of the 2010s. Was this large fiscal component in the 1930s the same bazooka-like bailouts for troubled banks, similar to what we saw after the crisis of 2008?
So there were some differences, different mechanisms, but a big part of it was the devaluation of the dollar compared to gold back then. And so one of the analogies that I often make is that in many ways the 2010s were a lot like the 1930s, and the 2020s are shaping up to be a lot like the 1940s. And what I mean by that is, during the really early part of the 1930s, you had a private debt bubble peak, that you had massive loan losses. And then you did have a fiscal component to kind of push back against that. But if you look at the relative magnitudes of how much private loans were destroyed versus how much fiscal response there was, the fiscal response was actually pretty small compared to the massive amount of private debt that was just erased. And so that's why, for example, we saw overall money supply actually went down for a period of time in the first half of the 1930s. The 2010s period, really kind of starting in 2008, but then extending into the 2010s decade, that one was a little bit. They kind of saw what happened in the 1930s, and this time they did a bigger fiscal response faster relative to the amount of loan losses, and so they roughly balanced out. We didn't really, if you look at a broad money supply chart, for example, during that period, you really didn't see a big decrease or increase. It's kind of they kind of balanced that out, but that caused all sorts of issues because, for example, banks, many banks got bailed out, but homeowners didn't get bailed out, right? So you kind of did a top-down style approach, and of course that naturally resulted in all sorts of pushback and populism because they rightly saw that as kind of kind of a corrupt thing to do. Now then, if you fast forward to the 1940s in the earlier example, that you had a much larger fiscal response because you're dealing with the external issue of the war and after this kind of decade-long period of stagnation. And so there wasn't really any loan losses. There was massive fiscal response. And so you had a really big surge in broad money supply, and that was a more inflationary decade than the 1930s. Similarly, when we look in the 2020s period, we've had this kind of decade-long period of relative economic stagnation, even though the stock market's done well. If you look at actual kind of labor participation, if you look at all sorts of different metrics like that, it's been kind of a weak decade. And then you have this external shock, you have massive fiscal response, the biggest money supply increase on a percent basis year over year since the 1940s. And so naturally, we're also getting a somewhat more inflationary impulse from that. And so, so far that analogy continues to be a pretty, kind of accurate way to think about this era, which is otherwise pretty unusual.
And do you recall from your research if this stimulus came about only after the abandonment of the gold standard by Britain and the US?
So that kind of came in parts, right? So basically, there were some early responses, kind of infrastructure type of things, and then the bank issues came in, kind of in periods. They actually kind of preceded the gold devaluation. And so it was kind of spread out. They started ahead of time, then they spread out after the gold devaluation. So the gold devaluation was kind of one big climactic moment within this kind of multi-year, set of policies that they did.
Government response. How about the government's response in the 1930s? Did it help to alleviate the economic stagnation of the Great Depression?
Well, I mean, the historians have different outlooks on how that worked out. I mean, you can argue, for example, that certainly the infrastructure projects were helpful in terms of getting some people back to work and kind of re-energizing that part of the economy. But it's one of those things where policymakers kind of contributed to it happening in the first place, right? The big kind of buildup in leverage and debt in the 1920s, and so naturally some of their reactions were also helpful in pulling it out of it. But in hindsight, if you would have had a more balanced approach to begin with, you could have avoided some of the excesses at the top, and then you could have avoided some of the excesses at the bottom. And so, then the 1940s, I mean, that was a period of, pretty strong growth in kind of the middle class, right? Because they put a lot of people to work that otherwise were not working. A lot of it was productive spending, right? So it wasn't say having people dig holes and then fill them back up and dig holes and fill them back up, as the saying goes. They were building, weapons of war, but then after that kind of transition back, they were able to repurpose a lot of that for domestic use, automobiles, civil aviation. Then they went forward with the interstate highway system, and so that was overall a pretty productive period. And people can debate about the nuances of it, but so I think some of the similarities stop there because, for example, we this past year we have not really seen the same type of infrastructure focus, right? So that's kind of the next thing that policymakers are juggling. We'll see what comes of that. And then also back then, the United States was a very large creditor nation, meaning that we had a trade surplus. We were a pretty strong manufacturing power. We were kind of, in some ways, the emerging market of the time compared to Europe. Until we emerged from the war, obviously, as a superpower. And so now we're kind of in the opposite situation where we have persistent trade deficits, and a lot of this funding is not really going into shoring up our manufacturing base or building out infrastructure or fixing some of our aging infrastructure. And so it might not have that the multiplying effect that some of those policies did, back in, say, the 40s.
That's a great point. We were a creditor nation back then. Staying in the 40s, though, a period dominated by inflationary, fiscal driven wartime finance, which you've compared with the 2020s. Are we in sort of a war today? I mean, how do we compare peacetime finance to World War II era finance?
Well, so far, I mean, it's kind of similar because, they're essentially using the pandemic as the external threat to be, fighting, as well as just it's one of those things where COVID is just one part of it. The real kind of issue there is you had such a highly leveraged system that when you had a supply chain disruption, it could have been anything. It could have been, a volcano goes up in a crazy place. You could have had, some other natural disaster. So anything kind of disrupts this really intricate, highly tuned global supply system with leverage that is hundreds of percent of global GDP. And so basically, it's, I think a good way to look at it is the long-term debt cycle, which is popularized by Ray Dalio. And so that's kind of the overall framework for why the 30s and the 40s looked the way they did, right? So you had specific factors like the Dust Bowl in the 1930s. You had obviously the war in the 1940s, but many of things were actually interrelated, right? So basically a lot of the conflict in the 1940s was because of a lot of the stagnation and populism of the 1930s. Obviously it expressed itself in different ways in different countries. And so what we're finding now is that if you look at the kind of the framework of the long-term debt cycle, that's why we're seeing some of these echoes happen here, that it's not specifically the virus, it's not specifically, the financial crisis could have happened another year, but it's specifically the fact that so much leverage is built up in the system, first private debt, and now we're kind of moving on to the public debt portion, that has its own set of consequences. And the actual, the specific shape of that can take multiple forms based on policymaker decision, based on luck, on random events. But the overall kind of fragilities were already there.
You think if the government goes on with continued stimulus, how do you see, is this really going to start to trigger off inflation?
Well, we already start to see now that we are, for example, we have the highest core CPI year over year since 1992. Just got reported. CPI is touching about 5%. I think that's not the perfect measure of inflation, but even using that official metric, it's running kind of hot at the moment. Part of that is from base effects. Part of that is from, basically a pretty significant increase in broad money supply combined with some supply shortages. So overall, my base case is that it's probably going to come in waves, right? So instead of just seeing this persistent inflation month after month go up and up, it's going to be waves depending on whether we're doing fiscal stimulus or not. And so, for example, as we look out later this year, some of the fiscal stimulus starts to wear off, right? So people are not getting stimulus checks, they're not getting, these PPP loans turn into grants. Congress is kind of in gridlock at the moment, so we'll see what happens with infrastructure. It's hard to say when that will pass, what the magnitude will be. My base case would probably be that they'll do something before the midterms, but that's certainly a slower kind of draw out of money compared to stimulus checks that are more like an adrenaline shot right away. And so I think we have to watch things now like wage inflation, as well as the tightness of the energy market, right? So one of the things kind of holding down inflation over the past year was that we've had a lot of excess oil supply, and in many cases we still do, but because we have not had a lot of capex for a variety of reasons, I think as we look at it a little bit further, the energy market can get tighter in the years ahead. And so overall, I think that it won't be a straight line. I think we'll have periods of inflation, periods where it cools off again, and then it partially comes down to what fiscal policymakers do, because like the 40s, this is a very fiscal driven type of inflation, whereas the 70s was a somewhat more of a bank loan type of inflation. So I think a lot of people looking back at the 70s as their kind of model for this, whereas actually I think that the 40s are the closest example we have of this sort of period.
It's a great point. Speaking of the 40s, that massive fiscal response to World War II resulted in a ton of industrial production like tanks, planes, weapons, and supplies to support the war effort. Today, though, I don't think there was a similar quantity of goods, let's say, produced from this fiscal response. Would that point make any difference in your comparison to the 1940s and 2020s?
Well, I think there's a couple things both in favor and against. And so, on one hand, the 40s had stronger demographics, which were more inflationary. And as you pointed out, a lot of that was to boost production, which, you had a period where, for example, you put a lot of money into the economy, you get commodity shortages, and so you get these periods of inflation. But then in the long run, as you built those factories and as you increase the production, that put downward pressure on inflation. On the other hand, here in the 2020s, on some cases we have software is very deflationary. The demographics are older and more deflationary, and so some forces are actually stronger deflationary. But then, as you pointed out, a lot of the stimulus efforts that we're doing they're mostly just kind of changing the ratio of money supply compared to debt in the markets, which is something I've been talking about for a few years. And so it's kind of this anti-deflationary force kind of unraveling parts of the debt bubble that's happening, and that has its own inflationary consequences. And so actually, one of the things we're seeing is a lot of people are saying, oh, the inflation is not real because it's just based on COVID supply constraints. But if you look back in history, every inflationary decade, pretty much by definition, has supply constraints. That's how it works. You get a significant increase in broad money supply that boosts demand in all sorts of ways, but for whatever reason, some aspect of supply is unable to keep up because the investments were not well timed or misplaced, or there's some sort of geographical issue. And so, for example, in the 1970s, you had oil shortages, partially based on geopolitical reasons, also just because growth is very quick in some cases, and so you just kind of ran out of oil capacity. But a lot of it was the geopolitical aspect. In the 1940s, you had commodity shortages, right? Because you needed pretty much every scrap of commodity you could get. The increase in the broad money supply due to the fiscal stimulus basically created all this demand that might not otherwise be there, and so you ran into real world constraints. And so what we're seeing in the 2020s is that people got stimulus checks, people got unemployment benefits, and that was able to increase demand. But then you start running into real world constraints. It could be paper towels, they ran out of those. It could be certain food items, especially meats and things like that. It could be, energy's not really been super tight, but for example, a lot of commodities have been pretty tight. Shipping capacity has been tight. Semiconductors have been tight because there's only a handful of countries in the world that produce most semiconductors, and so we are kind of running into some of these real world constraints. And that's not an exception to inflation. That's part of why inflation happens.
And you touched on political, geopolitical, especially. Wouldn't all hell break loose inflation wise if we did have some geopolitical hotspots, even a World War III added into the mix in this decade?
Almost certainly, yes. I mean, right now, for example, a lot of our supply chains in the United States are intertwined with China. The same is true for Europe and China. Singapore, for example, is a really big hotspot for global trade. We have a very interconnected world. There are some countries that are a little bit more isolated than others in terms of, say, trade as a percentage of their GDP. Like India is a little bit, lower on that percentage. Japan's a little bit lower on that percentage. But a lot of those the trade that happens is essential things like semiconductors. And so, if you were to have kind of a tail risk of really kind of bad breakdowns in terms of geopolitical relationships, that would certainly be inflationary. And also, I mean, even in a more gradual sense, the past 25 years, part of what's held down certain types of inflation is the globalization that we've done. And so, for example, things like education, healthcare, childcare, we've had very strong inflation in those sort of service-oriented things. But things that we were able to outsource to cheaper markets, like electronics manufacturing, broad kind of cheap manufacturing, those prices have been very low. And so if we start to, we've kind of hit the end of that road, I think, in terms of how much we can do. And it's one of those things where that's had different impacts on different types of workers. And so, for example, that's been pretty good for say, the upper 10% of society that doesn't really make things, but then benefits from those cheaper products. But that's been pretty bad for, say blue collar workers that would otherwise have made those products in the United States. And so I think there's more of a political will to pull some of the supply chains back to be less reliant on external countries. And one of the kind of the risks of that, you get a lot of benefits from it. You get increased resiliency, you get increased local work, but then you also are likely to get higher prices for some of those things because you're not outsourcing to whatever market is the cheapest.
Yeah, another great point there. Lynn, looking at the repeating patterns from the 1930s and 1940s, what do you make of it? I mean, why are the fiscal responses still similar some 80 years on?
A lot of it has to do with that cycle of interest rates. And so, the whole concept of the long-term debt cycle is, so if you look at the short-term debt cycle, right, the 5 to 10 year business cycle, the whole thing that happens there is you get leverage building up in the system, and then some sort of external catalyst comes, or policy error or something like that, and you get a deleveraging event. But then policymakers jump in. They don't want that deleveraging event to take too long. People get angry because it's a recession, so they cut interest rates. They do all sorts of things to try to stop the bleeding and stop that deleveraging. And so what happens is at the end of the cycle, you never fully deleverage compared to the beginning of the cycle, right? So you build up debt, then you decrease it a little bit as a percentage of GDP, but you didn't really get down to where you started. And so when you string multiple of those short-term business cycles together, what you end up getting is higher and higher debt levels and lower interest rates in each cycle, basically higher highs of debt and lower lows of interest rates. And eventually policymakers run into roughly zero interest rates, or in some cases mildly negative interest rates, and they can't really go any lower. And at that point, debt is extremely high and is very reliant on those low interest rates. And so what happens in that event is, what policymakers turn to is essentially a currency devaluation, where they focus on fiscal stimulus, and then whatever inflation comes from that, they still do, they hold interest rates near zero. They do essentially financial repression. So, if you're holding money in a bank account, you're getting paid less than 0.5%, while inflation's running 3, 4, 5%. In some cases more. I mean, the 1940s hit very high levels, and so that basically inflates away part of the debt. But then also, if you are a bondholder or a cash holder, you're also essentially inflating away part of your purchasing power. And so that's really what separates that long-term debt cycle, is that policymakers essentially box themselves into a corner where interest rates are super low, debt's super high, and other than inflating part of that debt away, they don't really have a ton of options for how to get out of that.
You mentioned negative rates. Just want to ask you a question. The reverse repo market has been pretty active lately with the Fed. Do you think they're trying to have some kind of a floor so that rates don't go negative?
That's essentially what they've been doing. Yeah, basically, it's kind of the opposite problem of late 2019 repo spike. And so back then, you had too many T-bills compared to the amount of reserves in the system, and so they responded by creating bank reserves to buy T-bills, essentially monetizing U.S. debt. Now here in 2021, what's happening is that they've done so much QE that banks are so full of reserves that they don't really have anywhere to put it, and they have certain kind of regulations like the SLR for how much basically deposits they can accept, and how much overall balance sheet capacity they have. And so one of the things they're doing is basically reverse repo is kind of a liquidity sink. Banks are able to put that capital in there, and that stops basically T-bill rates from going negative, and basically is a spillover. And part of that, I mean, it's compounded by the fact that the TGA is being drawn down. So the Treasury General account is going back down from its very high levels of I think it peaked around 1.8 trillion. As that goes down, that money is getting pushed back into reserves, into bank reserves, and so that's also contributing to this excess liquidity. And so for this period of time, that's essentially a liquidity drain. You can think of it as almost the exact opposite scenario of 2 years ago.
Should this the reverse repo market right now, should this be something that we should all be concerned with?
It's certainly something I'm watching, because it could affect policymaker decisions about when they want to taper quantitative easing. They might adjust some of the interest rates on excess reserves. And so overall, they might do some policy tweaks. They're also talking about making some of those facilities more permanent or broader, like the number of entities that can access those could be broader. And that has implications for long-term liquidity. But overall, it's there's a lot of kind of sensationalist content about that, about how it's going to cause major disruptions. I don't view it in that sense, but it is something I'm watching pretty closely, because it basically is showing that we're kind of at maximum liquidity right now. That any more liquidity just gets sucked right out anyway.
Given that humankind has never printed so much money in history like today, with exponential increases in debt and money supply seen in many of the Fed's charts, and that governments have no viable solution to normalize the situation, are you expecting sort of an economic mega tsunami heading our way soon?
Well, mainly what I'm watching is, kind of a lengthy period of persistently negative real rates. I think that's what policymakers are aiming for. They've even been pretty explicit about their intentions. And so, for example, if you look back for the past decade, T-bills spent most of their time with negative real returns. And I think we're seeing that playing out again here in the 2020s to an even bigger degree, and including a lot of those longer duration types of bonds as well, where if you hold a 5-year or 10-year treasury, by the end of this decade, I think you're going to have less purchasing power from that bond than when you originally bought it. And so I think that's kind of the biggest takeaway of this decade. Now, whether or not we get tsunamis, economic tsunamis, a lot of that partially depends on individual countries' political situations. And so there are kind of these powder kegs around the world. I mean, Europe obviously has an issue, with the way that the euro is constructed between, say, the political disagreements between, say, Germany and Italy, for example. because a lot of them have essentially ceded control of their currency. We also have the United States. You have a very high degree of political polarization. So we'll see how that plays out in the midterms and then the next presidential election. And so I do think that there are a variety of tail risks related to geopolitics as well as internal politics. But pretty much the highest probability outcome is that this can take multiple forms, but that cash and bonds are unlikely to hold their purchasing power throughout most of this 2020s decade.
Okay, so let's say these things, they just can't seem to hold their purchasing power. Is the US dollar become at risk as far as being the world's reserve currency?
Well, so I do view us as shifting more and more towards kind of a multipolar system where, the United States has had this situation for most of the past 50 years where it was the only currency that could be used to buy oil in most cases. So if any country in Europe was buying oil from Saudi Arabia, if Japan was buying oil from Saudi Arabia, it was all in dollars. And what we've been seeing in the past few years is that there are countries like Russia that have been kind of shifting away from that and being willing to sell oil in euros, and that there's buyers of that oil like Europe and China that are willing to pay euros. And so we are seeing diversification both in terms of reserves as well as commodity pricing. And my base case is that that's going to continue throughout the 2020s, regardless of the strength of the dollar. So, if you look in past history, the dollar's had these two really big bear markets, one in the late part of the 80s and the one in the early 2000s. And both of those were like 40% declines in the dollar compared to other currencies, and they didn't necessarily result in losing global reserve status. So instead, I think the main thing to watch out for is this kind of shift away from a U.S. centric dollar lock on commodities and towards this more multipolar world. Now, overall, I do think I'm somewhat bearish on the dollar with a multi-year view because if you compare it to say the euro, if you compare it to the yen, our real rates are lower, right? So if you include inflation as well as the rates on the short end of the curve, they're lower. In addition, the United States is, we're running larger fiscal deficits as a percentage of GDP. Our money supply is growing at a quicker rate as a percentage of GDP, and we have, kind of a trade deficit, a current account deficit compared to a lot of those other countries that have surpluses in those areas. And so overall, my base case is to probably see a weaker dollar, but that's somewhat separate from the fact that I think regardless of what the dollar does, we're going to get that spreading out in maybe a handful of major currencies able to buy energy products and other commodities.
A lot of people, always ask us about things like wealth protection, stores of value, and things like that. For the rest of us, is gold and silver in physical form high up on your list of assets to protect wealth in such a time as right now?
I think it's a good idea for a lot of people. And basically, there are relatively few assets that someone can have in their own possession, bearer assets that give them some degree of insurance, against some major tail risks. And so I do think that, physical gold, physical silver, even physical platinum, I do think they can be, useful hedges in someone's net worth. And then from there, they can, if they want to use ETFs to have liquidity in some of their portfolios, maybe their Roth IRA or something like that. There are ones, funds out there that are, say, physically backed. And then also people can get into the miners or the royalty companies if they want to have that more specific type of exposure.
Lyn Alden, before we wrap up, can you let our viewers know more about your work and the premium investment research service that you offer?
So I'm at lyndalden.com. Most of my material is pretty public. I also have a low-cost research service for people that want more tactical updates and more specific ideas. I'm also active on Twitter at Lyn Alden Contact, so people have a bunch of different ways to find me.
All right, Lyn Alden, we appreciate the time you've given us, and I hope we can do this again soon.
Thanks for having me.
That was Lyn Alden, founder of Lyn Alden Investment Strategy, sharing with us her views about the global economy. To find out more about Lyn Alden's work, please visit her website, lynalden.com. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And do also check out the SBTV podcast on iTunes and Spotify.